What if I told you there was a stock held by both Cathie Wood and Warren Buffett? What if I told you the stock is also 60% off its 1-year high? What if I added that I think the stock just bounced off its bottom and might make a strong reversal leading up to its earnings call in a few weeks? See, here's the thing. The idea behind this channel is simple. Connect the dots between ARK Invest's market research, stock picks, and daily trading data to highlight the best investment opportunities among advanced technology companies that are transforming our daily lives. These are big ideas about tomorrow that we can invest in today, and the companies with these big ideas tend to be smaller, scrappier, and much more volatile than today's tech giants like Apple and Amazon. And that makes sense, because Cathie Wood is trying to invest in tomorrow's Apple and tomorrow's Amazon, while investors like Warren Buffett are trying to buy today's already profitable market leaders at great valuations. That's why I was so surprised to find out that both Cathie Wood and Warren Buffett are invested in the same stock. Well, that company is called StoneCo, or Stone, and its ticker symbol is STNE. Warren Buffett's Berkshire Hathaway purchased about 14 million shares of Stone back when it IPO'd in October of 2018. That amounted to about 8% of the company, and Berkshire still has over 10 million of those shares today, or about 6% of the company. We can also find over 1.7 million shares of Stone in ARKF, ARK Invest's fintech innovation fund, even after it roughly 5x'd in 2020 before crashing by over 60% from its highs in February. Looking through ARKF's holdings is actually how I came across this stock in the first place. So in this episode, I'd like to share what I've learned about Stone and why these two legendary investors might both be holding it. Full disclosure, I just opened a position in Stone myself, in my $100,000 portfolio based on this research. Since your time is valuable, I'll talk more about how you can follow along with that portfolio project and get access to my real-time trade alerts at the end of the episode. For now, let's dive right into the company. Stone is a one-stop shop that provides small and medium-sized businesses in Brazil the fintech solutions they need to move away from cash and join the digital economy. The thing I want to point out about Brazil is that a lower percentage of people have internet there than in the US, Canada, and Western Europe, meaning Stone's base level market is still growing year over year as more and more people gain access to the internet. Only about 3 in 4 people in Brazil have access to the internet today. I think this is a big reason that over 2/3 of the country still prefers to pay for things in person and in cash, and e-commerce accounts for less than 5% of total spending in Brazil. Talk about a huge runway for growth. This is also why several of Stone's solutions focus on digitizing every part of the business, not just optimizing it. First, Stone has a point-of-sale solution for accepting credit cards, digital wallets, and QR codes, kind of like Square's payment terminal. In addition, they help businesses complete fully online transactions without any physical devices by generating payment links that can be sent to customers for quick and easy sales. So if somebody wants a product that they saw on Instagram or Facebook or WhatsApp, Stone can generate a link for them to pay directly for the item without needing to go through a website at all. That means that Stone can support micro merchants and very small vendors without actual storefronts or websites, which greatly expands their total addressable market. So, between their physical point-of-sale terminal and their digital payment and invoicing solutions, Stone can help any type or size business accept payments in every channel they're already operating in. That kind of scalability is important to long-term growth, but accepting payments is just the first piece of the puzzle. Another important thing to realize about Brazil specifically, and emerging markets in general, is that their banking systems can be fragmented and hard to navigate. So a lot of fintech companies are setting up end-to-end financial ecosystems for their customers. And Stone is no exception. They offer a business credit card that's funded by the sales from that store, which already goes a long way to helping store owners move to the digital economy. They also allow people to use the money from their store to pay bills and top up their accounts with services that they use, like apps, games, and transport. Think about being able to top up your own Uber account balance or Apple Wallet straight from the app that you use to manage your business. It seems like a little thing, but those convenient features are exactly the kinds of things that keep people on Stone's platform. And speaking of the platform, Stone's platform offers business intelligence and e-commerce analytics solutions so that business owners can start understanding their online data quickly and make improvements to every part of their sales funnel. Stone also has a lot of other financial services that can really help small businesses grow. They offer business loans with flexible payment models and cash advances based on projected cash flows. That's huge because small business owners that are still trying to find their footing might need that extra cash up front to fill a few extra orders sooner, and that could be the difference between success and failure early on. I think about this sort of like Square Capital, which is Square's lending and financial arm. They also help small businesses offer loyalty programs and incentives to their customers, which encourages repeat shopping and builds that brand loyalty, which is another thing that helps small businesses build that momentum that they need to stay successful over time. Stone even offers health insurance and life insurance, which are normally things that I wouldn't attribute to a fintech company, but it makes sense in this case because they're trying to be that end-to-end business ecosystem, and ensuring your assets and employees is part of running a business. I say this in every fintech episode I make, but I'll say it again here. There will never be a one-size-fits-all global fintech solution because every country has different regulations and infrastructures and cultures surrounding money and commerce. So one strong differentiator of Stone for me is that their entire business model is adapted to the Brazilian economy, which means they're constantly rolling out products and services that their core market will actually adopt. That's also why they have Stone Hubs, which are physical buildings that include staff for sales, logistics, and operations support. They're kind of like a Best Buy Geek Squad, but for merchants on the Stone platform. Pretty cool, right? In 2017, Stone became the first non-bank entity to obtain authorization from the Central Bank of Brazil to operate as a merchant acquirer payments institution. A merchant acquirer is a financial institution that maintains a merchant's account, enabling them to accept credit cards and settles credit transactions on their behalf. I think this is what Warren Buffett and Berkshire Hathaway really saw in Stone and why they invested so much money in it in 2018. For the next 3 years through 2020, Stone was the largest independent merchant acquirer in Brazil. During the first wave of the pandemic, when people started to handle more transactions digitally instead of with cash, 51% of all of Brazil's e-commerce volume went through Stone's platform. In late 2020, Stone paid about $1.3 billion to acquire a company called Linx, which is a leading software company that develops software solutions for merchants of all sizes. If you've been watching this channel for a while, you'll know my thoughts on these types of business combinations. Think Teladoc's merger with Livongo, Palantir's investments into over a dozen SPACs, Skill's acquisition of Archie, and all the other acquisitions I focus on when I talk about earnings on this channel. If you're newer to the channel, the nutshell is that the market unfairly punishes mergers and acquisitions because they show up on earnings reports as huge upfront costs that then pay off over long stretches of time. That means that Wall Street analysts who only care about quarter-over-quarter numbers see this as poor performance, while long-term investors see the value added much further into the future. The big synergy here is that Linx has been targeting medium and large-sized businesses, while Stone has been focusing on smaller businesses. Linx will help Stone serve more businesses in more verticals, as well as more tightly integrate their software and payment services, and provide better coverage of the different commerce channels that these merchants already sell through. They also have a lot of synergies because Linx is focused more on the software for workflow automation, resource planning, and business management, while Stone is focused more on credit, financing, and banking solutions. Stone also made a strategic investment in a company called Banco Inter, which is a 100% digital bank in Brazil that offers a complete suite of financial products and services to individuals. Banco Inter has a marketplace called Intershop, an investing service called Inter Invest, and an insurance service called Inter Seguros. Stone acquired up to 5% of Banco Inter, and as a result gets to put a member on their 9-person board. As a result of that, Stone's merchants can list their products on the Intershop marketplace, and Inter's customers will get access to a seamless payment experience for those merchants. So this is another big upfront cost that should provide a lot of returns in the long run. That leads me to Stone's vision of the future, which is to take all of these separate solutions and create a single financial operating system for these businesses, including online payments and sales, payroll, banking and taxes, business credit and loans, and other value-added services like insurance and loyalty programs. If that's starting to sound very familiar to you, it could be because Square also offers many of these same services. Square is currently ARK Invest's 6th biggest position overall and the number 1 holding in ARKF, which is the only ARK Invest fund that holds Stone stock inside it. That's how all of these pieces fit together. Okay, now that I've covered many of the different pieces of Stone's business and their future goals of turning these pieces into one unified fintech and e-commerce ecosystem, let's take a look at their latest financials from Q2 of 2021. Here are some important highlights. They have the highest total payments volume growth in the industry, largely driven by small and medium-sized businesses, and they just added a record number of them to their client list. Their payments and software revenues are growing fast, with their subscription revenues growing 90% year over year, and their revenues from transactions growing by almost 60% year over year. Stone says that they're already seeing the value of acquiring Lynx and are focused on integrating its software back into the rest of their solutions. And importantly, there's a big issue with their credit operations that was driven by higher levels of non-performing loans and non-performing clients. Let's talk about this right now because I think it's the biggest driver of their stock price falling over the last quarter. My basic understanding of this issue is that merchants have to put up a certain amount of collateral to get a business loan or a credit line. That collateral is registered with one of a few registries in Brazil. So this registry isn't something that Stone built, it's a new collateral system that they have to integrate with and keep up with as it changes over time. Due to a malfunction in these registries of receivables, merchants could put up collateral with Stone and then go apply somewhere else for financing and reuse that same collateral, because these registries aren't talking to each other. Then, when it comes time for Stone to take payments on the loan or take from a client's collateral, they found that the client can't repay the loan and the collateral is at least partially gone because the client had used it to secure another loan by using a different registry. So a lot of this earnings report touches on Stone's lessons learned and the actions that they're taking to remediate this situation, from temporarily stopping credit disbursements to increasing the amount of money they need to put aside to cover these unpaid loans. This money comes out of their total revenues. So to fix this issue in the future, they're bringing in a more experienced team to improve their credit scoring and risk assessment, changing their policies around accepting and recovering collateral, and partnering with other companies to spread around the risk. The big lesson learned here for us investors is that fintech companies in emerging markets come with real risks. Brazil's collateral registries not talking to each other is a real thing that happened, and it cost Stone and their investors a lot of money. I'm not a financial advisor, but in my opinion, this risk is now at least partially priced into the stock. Stone has been taking corrective action to fix it for a quarter now, and we should look to see some of the results of those actions when they release their next earnings report in just a few weeks. Taking a step back, the rest of Stone's growth is awesome. Their total payment volume from small and medium-sized businesses has grown by more than 90% year over year. Micro merchants and individuals are serviced through a sub-brand of Stone called Ton, and total payment volume for Ton grew by a whopping 27x year over year. That's over an 18% increase in total payments quarter over quarter. It's also important to recognize that this is good, healthy growth. Stone added over 47,000 new SMBs and over 140,000 micro merchants to their platforms this past quarter, and the average payment volume per client has gone up as well. So more users and more payments per user. Nearly half of all the small businesses on Stone are active in multiple financial solutions, and that number is steadily increasing over time. This is important because it shows us that Stone is benefiting from network effects, meaning they're acquiring new clients once, but making money off them in multiple ways by cross-selling and upselling them on other financial services, which lowers their total customer acquisition costs substantially. As a result, the number of payments, total payment volumes, and total account balances with Stone are up almost 4x year over year. Here's what I would call the Cathie Wood slide. Cathie Wood often says that she looks for companies that are investing in themselves to dominate their markets in the future at the cost of sacrificing profits today. Investing in people and skills is always a good thing. This slide shows us how Stone is doing just that. They've almost doubled their sales, technology, and client services teams. They've also almost tripled their marketing spend, which does make me a little nervous, but a lot of this marketing spend is probably to keep brand awareness as high as possible. That way, as new businesses come online, they'll be more likely to try out Stone's solutions first, since that's the name they'll be the most familiar with. This is definitely something we should be keeping an eye on as investors, and according to their overall quarterly data, that appears to be working. 45% growth in small business clients year over year, almost a 10x in active micro merchants, and almost a 60% increase in total payments volume. Here's the impact of that credit and collateral problem that I just talked about. Total revenue is down by 8% from a year ago because of all the money they have to keep to the side and the costs of solving the problem itself. This issue is what's causing their costs and expenses to be much higher than usual, driving their margins and their net income straight down. So our investment thesis in Stone depends on whether or not we think that they'll be able to solve this problem in the near term, or whether they'll keep bleeding money on these loans. We should get a better gauge of how they're handling this in their next earnings call in a few weeks, so I'll save the rest of my analysis on their financials until then, and if there's something worth updating you on, I'll make a follow-up episode as usual. For now, comment below or tweet me at tickersymbolu with your thoughts on Stone. Is this the kind of stock you expected Warren Buffett to be holding? What about Cathie Wood? Are you interested in this stock yourself? I'm excited to hear your thoughts. Speaking of the stock, it's climbed over 20% in the last 4 trading days, marking at least a temporary reversal from its steep downward trend over the last 8 months. Can it go lower again? Absolutely. I'm not a financial advisor and this is not financial advice. But do I think that right now could be a good time to buy Stone stock? Absolutely, because I believe that they'll be able to solve this credit collateral issue, and I think their acquisition of Lynx and partnership with Banco Inter will pay off for years to come. That's why I've just added this stock to my $100,000 public portfolio that I'll start covering when this channel hits 100,000 subscribers. I'm building that portfolio from scratch to compete directly with ARK-K, ARK Invest's flagship innovation fund. So if you're interested in jumping on that wild ride with me, consider liking this video and subscribing to the channel with all notifications turned on. That way you'll be the first to know when I come out with more deep dives of great stocks like Stone, as well as exactly what I'm putting into my portfolio each month. It takes me a few days to put together each episode, so if you'd like access to my trades as they happen, instead of waiting for me to release these videos, and for these stocks to pop 20% or more, consider supporting the channel as a patron on Patreon or channel member right here on YouTube. My wonderful supporters and community are what makes this channel and all of my crazy investment projects possible, and that means the world to me. If that's not really your thing, no problem. I hope to run this portfolio project for at least the next 5 years, and you'll be able to follow along right here on the channel that invests in you. So thanks for watching, and until next time, this is Ticker Symbol U. My name is Alex, reminding you that the best investment you can make is in you.